Good afternoon. Thank you very much for attending. I am Sensei Kevlar, and I'm here to talk to you about how to stop drawing trend lines, because for a little while now, I've been preaching to you, draw these trend lines, draw these trend lines. These trend lines tell you where the market is going. And now I'm going to show you how to, now that you know how to draw trend lines, now that you know you have built up the muscle memory to actually start seeing the trend lines. I mean, there's obviously, resistance here and support here, and we've got sort of a long-term trend. We got sort of a negative trend forming that got broken. What can we do to ease our pain on this? This is very much a situation that we can bring in some automation to help us with. And automation starts fundamental and then becomes more sophisticated. And a lot of people look at the automation that's available to them. They look at the indicators that are available to them, and they don't take the time to really break them down and understand what the indicator is telling them. They hear that the RSI above 70 means sell and below 30 means buy. But why? What is that really doing? What's really happening here, right? We know that we're in a market middle here. Is there indicators that can tell us better that we're in a market middle without us having to draw these lines? There is, and there's ways of thinking about this. So what I'm going to do is I'm going to start by breaking down a chart from sort of a programmer's perspective. Ultimately, this is just a series of numbers. We're talking about a series of numbers over time. And more importantly, we're talking about a series of linear numbers that march, the linear aspect of the numbers is they march progressively forward. They never go back. So we can think about this in terms of a window. And when I say a window, what I really mean is if we were to take, for instance, the current bar, and then we were to do an analysis, and we were to pick some time frame in the past. Let's say that we chose 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 time frames in the past. Okay, this is the chunk that we would look at. And how we would break down this chunk is we would say, what is the close of this candle? What is the close of this candle? This is a number. What is the close of this candle? This is a number. What is the close of this candle? This is a number. And on and on and on. And we would build out a series of numbers. Okay, and then this is how we would start our analysis, by looking at this window of numbers. Now, when I talk about a moving window, what I mean is that when I go to do this computation for this period, for this point, this line, this indicator that's going to signal right here, what I'm doing is I'm doing the math on this whole window. Okay, and then when I do the calculation for this point right here, I'm doing it on this whole window, and the window moves. Okay, so if I want to do it if I want to figure out where the indicator was signaling right here, right, what I would do is I would be doing that calculation on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, this series right here, this series of numbers. I think I probably missed one there, right? This series of numbers. Okay, so let's do that. Let's treat this like we're actually a computer. Okay, and we're going to use some made-up numbers, because made-up numbers make things a little bit easier. We're going to pretend this is a market that's relatively stable and has some logic to it. We're going to say that we're going to start out the market, and the market's going to start out at $100. And then, so this is $100 right here in our first bar. And then the next bar is going to be, we went up to $104. Okay, and the next bar is we went up to $106. Then we went back down to 104. Then we went down to, we took a big plunge to 98. Then we went to 97. Then we went to 99. Then we went to 102. You could totally see how this is, a very, very, a very reasonable chart across basically any time frame. Charts do this all the time. Well, let's take a big spike up to 108, and then 122 to really give us an extreme, and then 130, and then 122 again, and then 118, and then 118 again, and 118 a third time, and a fourth time, just to see what happens when we stagnate and go sideways, and then 115. Okay. This is our series as we have taken it from the close of our candles. We've taken the price out and we've put them into a series. And what we're going to do is we're going to do our computations across some window of that. For the RSI, what we're going to do is we're going to start by computing. When we're doing trend lines, what we're truly trying to do is we're trying to find changes in the direction of the market. That's really what we're talking about. When we're looking for a resistance line, we're looking for a change in the direction of the market. When we're looking for a support line, we're looking for a bounce off of the support line and a change in the direction of the market. It was going down, we hit this indicator, now it's going up. It was going up, we hit this indicator, now it's going down. So the way to think about this from a programmatic perspective is we want to measure the difference between going up and going down, okay? That would tell us if we're doing more going up than going down, or if we're doing more going down than going up. So what would that look like? This is our price, and this is the average, this is the difference upward in absolute numbers, how much we went up absolutely, and this is the difference downward. Okay. Now let's compute these numbers. It's fairly straightforward to do since we use nice whole numbers, right? Here we don't have a difference yet, but here we did do a difference upward of 4 because we went from 100 to 104, which was a difference upward of 4. Here we went from 104 to 106, which is a difference upward of 2, okay? Here we went from 106 to 104, which is a difference downward of 2. So I'm going to put a 2 in this column over here. We're only measuring ups here, and we're only measuring downs here, and we're measuring them in terms of difference, absolute difference. We're not measuring, we're not saying positive or negative. We're simply measuring, we're making different windows, right? We'll keep going like this. 104 minus 98, difference downward, downward of 6, difference downward of 1, difference down upward, I'll get it right, of 2, difference upward of 3, difference upward of 6, difference upward of 17, difference upward of 8. Finally, we get a move back downwards here, difference downward of 8, difference downward of 4, nothing, 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 difference downward of 3, okay? Now what we've done here is we have separated our upward motions from our downward motions. And what we can do is we can say, over a given time frame, how much did we do up and how much did we do down? So for this time frame, I'm going to say our, this is our totals for this time frame, and at the 10 time frame, what we had is we had the sum of B3 to B10 effectively, or actually we want 11 because we're doing, no, we'll do 10, right? Okay, and then we can just copy that one on down. Is our totals upward. Okay, except we don't want to, we want to keep moving the window downward. So in this one, we don't want to include, we want to use, right, this is what we said, B3. We really meant, yeah, we meant B3. So this is B3 to B10. This is B4 to B11, that's correct. This is B5 to B12, that's correct. This is B6 to B13, this is correct, right? So this is the total of this window right here. This is the total of this window right here. And what we're doing is we're plugging it in on this line, right? So we're looking backward in time and we're saying, where were we in the past? And then we're going to compute our current number. Let's do the same for the totals downward. Okay, It's basically the same formula. What we're going to do is we're going to do a sum of B3 to B11, just like we did before. And we're going to copy that and copy that. I'm sorry, it's not B3 to B11, it's C3 to C11. And we're just going to copy that on down. I could stop screwing that up. Okay, so this is C4 to C12, this is C5 to C13, et cetera, et cetera, et cetera. Okay. Now what we want to do is we want to find the average, right? Because these are pretty raw numbers, but we want to sort of average them together. So this is divided by 10, and we can just copy that on down. Okay, and this is divided by 10, and we can just copy that on down. All I'm doing is computing the average, because this is divided by 10, because there are 10 samples in our set. Okay, and now what we have is we have the moving average of the difference upward and the moving average of the difference downward. So in the past time frame, we did 1.7 on average, and when you include the next time frame, we did 3 on average, and when you include the next time frame and drop out the last, we did 3.6 on average, right? And we keep on, doing these nice motions up, and then eventually the run sort of peters out, right? As we get these as these larger numbers fall out of our set, the number starts to fall because we're not doing any motions upward anymore. Okay, so what we can see is that as these numbers ramp up, and then as these numbers go down, this number slowly starts to ramp down over time. Even though we've had no numbers here, this number is just ramping down over time because we're including less and less numbers in the sample size. You're right, it is 14. What did I do wrong there? 14, thank you. Same thing over here. As the downward motion ramps up, the numbers here ramp up. As we continue to ramp up, the numbers here continue to ramp up because we're measuring the average of a moving window. We're always measuring 10 sample sizes. Okay. Now, what we want to do is we want to make a comparison between these two. We want to say, did we do more up than down, or did we do more down than up on average? Okay, and this is the basis of the RSI. We're trying to measure the relative strength of the market. Is the market going more up than down, or is the market going more down than up over this time frame? Okay, and then what we want to do is we want to move this number into a formula that will allow us to sort of visualize this in a more meaningful way. So here's what that formula actually is the RSI is equal to, and this is just, if you understand how graphing works, this is sort of a graphing trick. You take 100 and you minus 100, you divide that by 1 plus, and this is really just, how you create a centered graph around something. And then we plug in the average upward price change divided by the average downward price change. And that forms our RSI. So what is that doing? Well, let's find out. We'll plug it in. We'll say 100 minus 100 divided by 1 plus D2 divided by E2. Close out that clever little equation there, if I don't screw it up, and get a nice divide by 0. What did I do wrong? Now let's take it one step at a time, right? Oh, thank you. Thank you. You're right. Duh. Okay. What this is this is a number that is centered. Let's do it for a false number, right? Let's just plug this number in for 1 and 1, this equation in for 1 and 1, and we'll see what happens, okay? What this is that when these two numbers are identical, when these two numbers, when we are doing an equal amount upward and an equal amount downward, this number becomes 50. If we do more upward than we do downward, this number climbs above 50. If we do more downward than we do upward, then this number starts to climb below 50, okay? What we're doing here is, you can see the minute that we did a nice move difference upward, we went all the way up to 75 on our RSI. Let's plot this. Not a column chart. How about a line chart? Yes, okay. The minute that we did this fun spike upward, the RSI went like this, okay? Then the RSI came back down, got close to 50, didn't quite touch 50, and then came back up and did this nice little thing. And this is actually correctly modeling, if you want to compare this to our time frame. Let's plot it against our time frame. This is correctly modeling the trend, right? If the trend was a big spike up followed by, you know, some more motion in here in order to keep us from going down, then we did this return right here, right? Is there was this we expected it to fall, and instead it stayed steady here. What we were trying to do, what this was trying to do, was this was trying to climb back to 50, and then this motion right here kept it above 50, right? That's this spike right here. So what we're really measuring is we're doing a programmatic trend line. This line right here actually describes the difference of, let me bring this back out of the way, if you could just pull that, please. This describes the difference of our total trends, our total motions upward, and our total motions downward. So, do I want to sit here in Excel and do this all day? Hell no, and I don't actually expect anyone to actually do that themselves, right? What I expect you to do is expect you to come in here and pull in the relative strength index. But you need to know that what this is doing is this is taking a window, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, looking 14 bars back, measuring the number of differences of up versus the number of differences of down, averaging them, dividing them, doing the centering trick on the graph, and then displaying a graph for you. Okay, so we can change the number of bars that we want to look back, and we can even use a different source instead of the close. We can use the open or the high or whatever. I like the close. So 14 is usually a good place to start, right? So let's take a look at what we can learn from this. Well, turns out the RSI actually told us very, very well when we went way too high. The one time that the RSI really broke above 70 right here, so this is 70 and this is 30. If we are going sideways, the RSI is going to be right here in the middle, right at 50. If we are going up and up and up, then the RSI is going to go up and up and up. And then the minute that we start going sideways, the RSI is going to come back down to 50. Okay, so this is correctly, so if the chart goes up and up and up and then goes sideways, the RSI will go up and up and up and then down and down and down until it reaches 50 again. This is measuring the difference in trend. We are seeing a change in the trend. We are seeing more of a bull trend here than we are a return to the norm. Okay, this is the return to the norm. That's what that is. Anything above 70 and then we go back to 50, that's a return to the norm. Okay. Now, how can we use this? Well, this can often be even better indicator than the Williams indicator. Look at how strongly correlated the RSI and resistance lines are. Why? Because other traders are using this. Other traders are looking at these trend lines and they're going, wow, look at where the RSI is. Look at how much recent buying we did. There is no way that the whales are not now absolutely prepared to start taking profits after a motion like this and seeing the RSI like this. The whales are going, oh yeah, man, I bought in down here. Of course I'm going to sell when the RSI is up here because I know I'm not going to get a better price. I know that when this happens and when this happens, we're due for a sell-off, okay? The question is how much of one? This is a very, very strong indicator. This is an incredibly strong indicator in a market like this, where we have over and over and over again these correlations. Let's go back and find other times that the RSI went above 70 and stayed there, went above 80. Let's say 80, right? Let's not even do the 70. Let's make it 80 on this chart, right? Where did it touch 80? It touched it right here, and it touched it right here, okay? Well, that probably wasn't a good one. RSI alone couldn't have told us that we were about to go sideways unless you paid attention to it long term. And it told you that there was a normal return to the middle. Okay? Don't be fooled just by thinking the RSI is hitting 80, it's time to sell. It's not. It's time to pay attention to what the RSI is really telling you. The RSI is telling you that we have done a bunch of motion upward, but we're making a steady return to the norm. Okay, what is the RSI telling us here? It's telling us that we were too high, we were entirely too high, and we made a quick correction towards the norm. Okay, this is not a valid buy signal by any stretch of the imagination. This is caution. This is caution, right? This is we are too high. This is profit-taking opportunity. This is, then can we come back down over here? Is this a valid buy signal? Yeah, I'd say it is, right? But be careful. Look at where you really are. You're really in a market middle. Can you buy market middles and be profitable? Sure, if you plan accordingly. What if you need to go down to 6 more bottoms before you reach the true bottom? Okay, absolutely. You can be profitable because you can buy back in down here. And then you can be profitable up here. If you buy back in correctly down here, you can be profitable in this leg if you choose to be. It all depends on what you want to be. So the RSI will tell you even more. And what we're going to do is we're just kind of keep on bringing in more and more and more and more and more. Now the RSI uses a, oh, it's terrible. I'm going to get booted here in 10 minutes. We'll just restart the meeting. The RSI uses is a really strong indicator when we're going up and up and up that we are oversold, and it's a really strong indicator when we're going down and down and down that we are, are overbought, and when we're going down and down and down, we are oversold. Now, the thing I really want to caution you here is this is not a magic bullet. This is by no means the actual truth. You should never look at the RSI and go, we're oversold, I'm going to sell, I'm overbought, I'm going to sell, and then walk away, right? This is a tool in your toolbox. And what it can do is it can really help you to, at a glance, see that you didn't actually need to draw this trend line. Why? RSI trend line was already there for you to see. Okay, I drew this trend line myself because I know to draw that trend line. But if I didn't know to draw that trend line, could I look right here and see that there was a very obvious trend that was very clear? That we had gone from overbought to oversold? Yeah. Look at how that correlation on those trend lines occurs. Beautiful. Absolutely. And then look at what happened next. Okay. This is how I stopped drawing trend lines. Is I learned how to read the RSI, and I learned how to read what it was actually telling me. Because this is telling me that there is a downward trend. This is telling me that there is a downward trend, and the trend extends from overbought all the way through the norm down through oversold. This is a fairly good buy signal. When we go from overbought to oversold, that means we're in a volatility period. And it means that we definitely have the opportunity to then bounce off of here. But you want to look for a strong indicator. Can we find a strong indicator at this moment in time when I located this motion directly from the 70 to the 30 line? Yeah, look at this Williams right here. Beautiful, nice, solid ramp up in volume. Could I have gotten in off of a second test of this line? Absolutely. Could I have seen this, said, I think I'm going to wait, seen this, gone, double bounce, triple bounce, and then I'm going to buy in, and then I'm going to be profitable? Absolutely, no problem. Okay, but I needed to plan for that. I needed to absolutely make sure that my plan included me waiting until the RSI went from overend, and the RSI over. It's pretty close here. Seeing going to happen. Would I have deficit? I'm saying here, quadrupling up here, and quadrupling again down here, and again size 0.001 in. This massive ramp up in volume. Can I really double up, triple up, quadruple up, 5x up, 6x up on my position on a signal like this? Yeah, I can if I have planned to do that. Plan the trade, trade the plan. Because once you 6 up one time, doubling up on that position means you're 12x up. Okay, I want to say that again. If you do one position here and 5 positions here, you're now at 6x. Okay, doubling up down here puts you halfway in between for the profit opportunity, and you're suddenly at 12 positions. All you made was one market motion. You're at 12 positions. You had better plan for that. You had better plan for 24 positions, 48 positions, 96 positions. Okay, keep going. Can you really do that with your portfolio? You had better be prepared to if you want to stay profitable long term. Okay, and this is why position sizing is so incredibly important. This is why it's so incredibly important to plan the trade and then trade that plan and remain disciplined to that. I'm going to have to stop this and then re-invite everyone because it's kicking me off, but I do hope you will join me for the second half of this, in which we study